You think your bank account is just a place to store money. But what if I told you that every dollar in your account represents someone else's debt, and that this system has been quietly controlling who has power in society for over 5,000 years? I'm Tom, and this is Tom Thinks. I'm here to cut through the Wall Street jargon and give you the real talk on your money, even if it hurts your feelings a little bit. If you're someone who feels like you're always playing catch-up with bills, wondering why the rich keep getting richer while you're stuck on the treadmill, hit subscribe and give this video a thumbs up. Let's start at the very beginning, because to understand where we are, we need to understand where this all started. Look, most people think banking is a modern invention. They imagine stuffy buildings with marble columns and men in suits. But here's the thing. The first banks weren't buildings at all. They were temples. I'm talking about ancient Mesopotamia, around 3,000 years before Christ. The Sumerians had this brilliant, terrifying system. The temples stored grain. Farmers would deposit their harvest, get a clay tablet receipt, and could borrow against future harvests. Sounds reasonable, right? But here's where it gets interesting. Priests charged interest. And not just any interest, we're talking 20 to 33% annually. Now, imagine you're a farmer. You have a bad season. You can't pay back your grain loan. What happens? You become indentured. Your family becomes indentured. Your children become the temple's property. This wasn't just economics, this was social engineering on a massive scale. The temple priests didn't just become wealthy, they became the de facto rulers, controlled the food supply, they controlled labor, and they controlled who owed what to whom, and this pattern repeated itself across ancient civilizations. In Babylon, the Code of Hammurabi, one of the first written legal codes, had extensive rules about debt. Debt slavery was normalized. In ancient Greece, the situation got so bad that reformers like Solon had to institute what they called zeisakteia, the shaking off of burdens, where they literally canceled all debts and freed debt slaves. Here's what most people don't realize. Debt wasn't just about money. It was about power. It was about creating a permanent underclass that served the interests of the elite. The psychological genius of this system was that it made people believe they were responsible for their own misfortune. You borrowed the grain, you failed to produce enough, now you pay the price. It individualizes systemic problems. And honestly, we still do this today. We blame people for being in debt without asking why the system is structured to put them there in the first place. Now, I know what you're thinking, Tom. That was thousands of years ago. We've evolved since then. But stick with me here because the fundamental mechanics haven't changed. We've just made the system more sophisticated, more invisible, and more powerful. Moving on to the Middle Ages, where banking got a major upgrade. Here's the thing, while everyone was focused on kings and castles and knights, the real power was shifting to counting houses in Italian city-states. Families like the Medici in Florence, the Fuggers in Germany, these weren't just rich merchants. They were the original too-big-to-fail institutions. Now look at how they operated. Monarchs needed money for wars, lots of money, but taxing their subjects took time and caused rebellions. So what did they do? They went to the bankers. The Fuggers, for example, basically bankrolled the Habsburg Empire. They lent Emperor Charles V enormous sums to become Holy Roman Emperor. And what did they get in return? Mining monopolies, tax collection rights, the ability to control entire industries. This is where debt became weaponized on a geopolitical scale. A king who couldn't pay his debts became a puppet of his bankers. And the bankers knew this. They'd lend to both sides of a conflict. They'd profit regardless of who won. The psychological insight here is fascinating. These bankers understood that debt creates obligation. And obligation creates control. It's not about the money itself. It's about the relationship the money creates. The debtor must please the creditor. The debtor must maintain access to future credit. This creates a power dynamic where the borrower is always in a subordinate position. And here's what's really wild. These banking families started creating something called bills of exchange. These were essentially early forms of paper money. Instead of moving gold and silver around Europe, which was dangerous, they'd create paper promises, and those promises could be traded. This was the birth of modern banking instruments. But the real innovation was fractional reserve banking. Banks realized they didn't need to keep all the gold people deposited. They could lend out most of it, keeping only a fraction in reserve. If everyone showed up at once demanding their gold, the bank would collapse. but if they managed confidence properly, they could create money out of thin air. Literally, for every 100 gold coins deposited, they could lend out 90. Those 90 would get deposited somewhere else, and that bank could lend out 81, and so on. The money supply expanded exponentially. This is where debt truly became the engine of the economy. But here's the catch. This system only works if people believe in it. If confidence collapses, the whole thing comes crashing down. And that brings us to the next evolution, when private banking interests decided they needed government protection. To understand this better, let's jump to 1694. London. A group of wealthy merchants approaches King William III with a proposition. Government is deeply in debt from wars with France. The existing banking system is unstable. Their solution? Create the Bank of England. Now, here's the secret most history books don't tell you. The Bank of England wasn't just a bank, it was a deal. The government got a massive loan, £1.2 million, which was an astronomical sum at the time. In return, the bankers got something even more valuable. They got the exclusive right to issue banknotes, paper money backed by the full faith and credit of the British government. This was revolutionary. Before this, anyone could issue promissory notes. Now it became a government-sanctioned monopoly. And here's where it gets really interesting. Banknotes weren't fully backed by gold. They were backed by government debt. The bank would buy government bonds, then issue notes against those bonds. The government got its money, the bankers got a steady stream of interest payments, and they controlled the money supply. This created what we now call the national debt, and that debt became permanent. It was never meant to be paid off. It was meant to be managed, rolled over, refinanced. The psychological shift here was massive. Debt went from being something shameful, something to be avoided, to being a normal, permanent feature of national finance. The government wasn't a deadbeat, it was a sovereign borrower. And this model spread. Bank of France, the Reichsbank in Germany. Central banking became the new normal. But here's what most people don't realize about this system. It created a feedback loop. The government needs money, so it borrows from the central bank. The central bank creates money to lend to the government. That money enters the economy. Prices rise. The value of existing money falls. This is inflation. And inflation is a hidden tax. It erodes the purchasing power of everyone holding that currency. But it also erodes the real value of the government's debt. If you borrow £1 million and inflation makes each pound worth half as much, you're effectively only paying back 500,000 in real terms. Creditors get paid in devalued currency. The system is designed to slowly transfer wealth from savers to debtors, and the biggest debtor is always the government. Now you might be thinking, Tom, that's Europe. America was different. And you'd be right. America fought this system tooth and nail. Which brings us to our own story. Now look at America. We had a deep suspicion of centralized banking from the very beginning. Thomas Jefferson called banks more dangerous than standing armies. Andrew Jackson actually killed the second Bank of the United States in the 1830s. For most of the 19th century, we had what was called the free banking era. State-chartered banks could issue their own notes. It was chaotic. There were thousands of different banknotes floating around. Some were good, many were worthless. Banks failed regularly, and this brings us to the critical moment, the Panic of 1907. A series of bank runs threatened to collapse the entire financial system. J.P. Morgan, a private banker, had to step in and organize a rescue using his own funds and convincing other bankers to contribute. This was the wake-up call. The system was too fragile. Something had to change. And this is where our provided research comes into play. In 1913, after years of debate and political maneuvering, the Federal Reserve System was created. Now, here's what's fascinating about its structure. It was designed as a compromise, a hybrid system. On one hand, you have the Board of Governors in Washington, appointed by the President, confirmed by the Senate. That's the public side. On the other hand, you have 12 regional Federal Reserve banks. These aren't government agencies in the traditional sense. They're technically private corporations with their own boards of directors that include bankers and business leaders. This structure was intentional. It was meant to balance public oversight with private expertise, to prevent too much power from concentrating in either Washington or Wall Street. The Federal Reserve had three main jobs from the start. Provide an elastic currency, meaning create more money when the economy needed it. Supervise and regulate banks. Act as a lender of last resort during crises. But here's the thing most people miss. The Federal Reserve doesn't print money in the way you think. It creates money electronically through something called open market operations. It buys government bonds from banks. When it does this, it credits the bank's accounts with newly created dollars. Those dollars then enter the economy as loans. This is how the money supply expands. And this power, the power to create money, is arguably the most important economic power in the modern world. It determines interest rates, it influences employment, it controls inflation, and it's exercised by a group of people who aren't elected, who meet behind closed doors, and whose decisions affect every single one of us. Now, I know what you're thinking, but Tom, they're independent. They make decisions based on economics, not politics. And that's the theory. Let's look at how this actually works in practice. Here's where it gets really interesting. The Federal Reserve has three primary tools, according to our research. First, open market operations, buying and selling government securities to control the money supply. Second, the discount rate, the interest rate they charge banks for emergency loans. Third, reserve requirements, how much money banks have to keep on hand versus how much they can lend out. But honestly, since 2008, they've added a fourth tool that's become incredibly important: quantitative easing. Now, quantitative easing sounds complicated, but here's what it really is. When normal interest rate cuts aren't enough to stimulate the economy, the Fed goes out and buys massive amounts of financial assets, mortgage-backed securities, corporate bonds even. In some cases, stocks indirectly through exchange-traded funds. They create new money to buy these assets. This pushes up asset prices. It makes stocks and bonds and real estate more expensive. And who benefits from this? People who already own assets, the wealthy, the already established. Here's a concrete example. After the 2008 financial crisis, the Fed's balance sheet, the total value of assets it owns, ballooned from about $900 billion to over $4.5 trillion. That's quintupling the money creation machine. Then during the pandemic, it went from about $4 trillion to nearly $9 trillion. That's creating $4 trillion new dollars in about 2 years. Now, follow the money. The Fed creates dollars to buy bonds from banks. The banks now have more reserves. They can make more loans. But here's the catch. They don't lend to regular people. They lend to other financial institutions. They buy more assets. This creates what economists call the wealth effect. When people see their retirement accounts going up, they feel richer. They spend more, the economy recovers. But this recovery is uneven. If you own stocks, your net worth skyrockets. If you're living paycheck to paycheck, you might get a slight boost from lower mortgage rates, but you're not seeing your wealth multiply. There's another psychological effect here. When money is cheap, when interest rates are near zero, people and corporations borrow more. They take on more risk. They buy assets with borrowed money. This creates bubbles in housing, in stocks, in cryptocurrency. And when those bubbles pop, who comes to the rescue? Federal Reserve, as lender of last resort. This creates what economists call moral hazard. If you know you'll be bailed out, you take bigger risks. The system becomes more fragile, not less. And here's the real kicker. This entire apparatus is funded by debt. Government debt, corporate debt, household debt. The Federal Reserve manages this debt. It decides how expensive it will be to service. It decides when to let the economy slow down to fight inflation, knowing that will cause job losses. These aren't just technical decisions, they're political decisions with human consequences, and they're made by a small group of people in a room in Washington. So where does this leave you? Honestly, it leaves you with a choice. You can either be a passive participant in this 5,000-year-old system, or you can understand it and use that understanding to your advantage. Here's the thing. The system isn't going away. Central banking, fractional reserve banking, debt-based money creation. These are the foundations of our modern economy. You don't have to be a victim of the system. First, understand what money really is. It's not gold, it's not paper, it's trust. It's a social agreement that this piece of paper or this digital entry represents value. And that value is constantly being manipulated by the Federal Reserve and other central banks. Second, recognize that inflation is a feature, not a bug. The system is designed to have mild, consistent inflation. Why? Because it encourages spending and borrowing over saving. It erodes debt, but it also erodes your savings if they're sitting in a bank account earning 0.01% interest. Here's a concrete example. If inflation is 3% annually, which is roughly the Fed's target, and your savings account pays 0.5%, you're losing 2.5% of your purchasing power every year. On $10,000, that's $250 vanishing into thin air. Every year. Third, understand that assets and liabilities behave differently in this system. Assets, things that produce income or appreciate in value, tend to rise with inflation. Liabilities, debts you owe, get eroded by inflation. This is why wealthy people use debt strategically. They borrow cheap money to buy assets that appreciate. The debt gets paid back with cheaper dollars in the future while the asset grows in value. Now, I'm not saying go out and get massively into debt. I'm saying understand the mechanics. If you have a 30-year fixed mortgage at 3% and inflation averages 3%, you're essentially getting an interest-free loan when adjusted for inflation. Fourth, diversify outside the dollar system. This doesn't mean stuffing gold under your mattress. It means understanding that all fiat currencies, dollars, euros, yen, operate on the same principles. They're all debt-based. They're all subject to central bank manipulation. Real assets, productive businesses, real estate in growing areas, your own education and skills, these are what preserve wealth across generations. Finally, the most important step. Stop thinking like a consumer and start thinking like a capital owner. The system is designed to keep you consuming, to keep you in debt, to keep you focused on monthly payments rather than long-term wealth building. Your goal shouldn't be to have the nicest car or the biggest house. Your goal should be to acquire income-producing assets, to build a margin of safety, to reach a point where you're not dependent on a paycheck, where you're not terrified of economic downturns. Because here's the ultimate truth. For 5,000 years, the people who controlled the debt controlled society. Today, that control is more sophisticated, more diffuse, but no less real. You can either be controlled by debt, or you can understand debt and use it as a tool. The choice is yours. But first, you have to see the system for what it really is, not as a natural force, but as a human creation, one that can be understood, and one that can be navigated to your advantage.
Found this interesting? Subscribe to the channel. Give this video a like, share it out, and drop your questions or ideas in the comments. Until our next adventure.